I'm Kyle with Fundamentals of Finance, back with a super important video teaching you how to prepare your investments for the new normal. I think the evidence is becoming clearer and clearer that we're in the midst of a major paradigm shift in the equity markets, and most investors are not ready for it. The NASDAQ, the FANGs, the ARK Innovation ETF, and other high-growth, tech-oriented investments that led the market for the last decade are not going to bounce back quickly like they did in 2020. And I think that for at least the next few years, the kinds of investments that will thrive are very different than the ones we've been used to. Here I'll explain why this changing environment is likely to persist and how you can position your portfolios for the new normal. For some historical context, the NASDAQ, which is filled with high-flying tech stocks, crushed everything in the 90s. From October 98 to March 2000, it went up over 3x in a year and a half, only to give it all back in the next year and a half. Does this chart look similar to you? This is the ARK Innovation ETF over the last 3 years. It did even better on the way up than the NASDAQ in the 90s, up over 4x in about a year and a half, only to give it all back over the next year and a half. In the words of Mark Twain, history doesn't repeat itself, but it often rhymes. Both were concentrated with high-flying tech stocks that investors got overexcited about, and both came crashing down with a vengeance. So what happened to the NASDAQ next? Well, it actually fell another 30 or 40% over the next year, and didn't get back to its prior high for about 14 and a half years. Will history repeat itself exactly? I'm sure it won't, but it could rhyme, which is why you and all your friends who have a bunch of US tech investments need to watch this video. I'm not saying some of these high flyers aren't still going to be great companies. Microsoft, Amazon, and a bunch of other darlings from the late 90s were great companies, but I think it's going to be a harder path for them to be great stocks, at least for the foreseeable future. To put it very simply, two things drive stock prices: P/E, hence the PE ratio. The E is a company's earnings, which is the same thing as their profits. These companies can certainly still keep growing their earnings, especially once we're past the recession. However, it's the P portion of the PE that represents what investors are willing to pay for those earnings. And that's how you get to the stock price. In the environment we're entering into, the PE ratio for a lot of these companies is very unlikely to get back as high as it was before, meaning the companies can grow earnings again, but even when that happens, investors are not going to pay as much for them. For a simple example of how this is likely to play out, let's say a business was trading at a PE of 40. That means investors were paying $40 for every $1 of expected earnings. If the company's expected earnings were $5 a share in 2020 and the PE was 40, it means the stock's share price was $200. Maybe that company has been hurt and they're only going to make $4 a share this year, and their valuation or PE has gone down, which is the case for a lot of companies this year. So let's say its PE is down to 20 now. If it has $4 a share of earnings, that would make it an $80 stock, down 60% from its high, which is where a lot of high-flying tech stocks are right now. In the next year or two, their earnings might well recover back to their prior high of $5 a share. But in a higher interest rate environment, the valuation that companies can command will not be as high. So this company would not be likely to trade at a PE of 40 again. Maybe then they trade at a PE of 30. So even if their earnings recover to the same as before, their stock price will not recover to their prior $200 a share. It'll only recover to $150 a share, $5 per share of earnings times a PE of 30. These are all hypothetical numbers, of course, but if interest rates stay high, that is what's going to happen to all stocks. And it's going to be the worst for high growth stocks, the market leaders of the last decade. To be clear, I'm not saying they'll never go up again, and I'm not saying they won't recover, but I am saying I think it's extremely unlikely that they will recover to their previous stock price highs anytime in the next few years, and there could easily be more downside from here. Every single company will be impacted to some degree because of the way stocks are valued. This is an oversimplification of a very complicated process, but generally in order to come up with a fair value for a company, you discount the company's future cash flows back to their present value and add them up. So it will go something like, I think a company is going to earn X dollars next year, Y dollars the next year, Z dollars the year after that, etc. And based on interest rates, how much are each of those cash flows worth in today's dollars? Add them up and you have the value of the company. A dollar earned in the future isn't worth as much as a dollar today, right? There's an opportunity cost to waiting. If you have the money today, you could invest it, make money, and have more money in the future. So you have to discount future earnings back to their present value to see whether it's worth it to wait or if it will be better to invest in something else today. But how do you determine just how much a dollar earned in the future is worth? Well, that depends on the discount rate, which is based on interest rates. The higher interest rates are, the less a future dollar is worth today. For example, using some simple back-of-the-napkin math, if you could earn 1% without taking any risk, then $100 of earnings in a year will be worth about $99 today. That's how much you'd have to invest today to end up with $100 in 1 year. But what if interest rates were 5% instead of 1%? Well, then your $100 of earnings next year would only be worth $95 today, because you would only have to invest $95 today at the prevailing interest rates for it to be worth $100 next year. So as interest rates go up, future earnings are worth less in today's dollars. Interest and investment returns compound, so the further away these earnings are, the more their present value gets crushed when interest rates go up. And by definition, fast-growing companies have a higher percentage of their earnings coming further out in the future than slower-growing companies. The valuations, or the P that investors were willing to pay for the E, that these high-growth companies achieved in 2020 were at extremely low interest rates. Unless we go back to those interest rates, companies will not achieve the same valuations they had before. For any given individual company that can, maybe their earnings growth rate is higher than before, or their risk is lower. There are lots of things that impact valuations. But all else equal, tech and growth stocks broadly will not achieve the valuations they had before unless we go back to ultra low rates again. And I just don't see that happening anytime soon. Why not? Well, the Fed has two remits: inflation and unemployment. Right now, inflation is high and unemployment is low, meaning we have a strong job market. Interest rates are already way higher than they were before, hence why PEs have come down so much, and the Fed is planning to raise them even more to fight the stubbornly high inflation, which has a long way to fall before it gets close to their 2% target. That's likely a couple years away. Could they stop raising rates before we get to 2% inflation? Yes, they almost certainly will. But will they substantially lower them before we make a lot of progress toward that goal? Highly unlikely. That would increase inflation, which will be the exact opposite of what they're trying to do. I don't think interest rates are going to 10% or anything crazy like that, but here's a realistic scenario. The Fed raises rates a couple more times by early 2023. More weakness in the economy and job markets start to appear, and inflation starts coming down into the mid-single digits, maybe 4 to 6% instead of the 8.5% we're at today, but not all the way to their goal. At this point, they'd probably slow their rate hikes or maybe even stop them. It would depend on how low inflation gets and how high unemployment gets. They'll need to strike a balance of trying to get inflation down without crushing the job market too much. If we went into a deep recession and unemployment went up a ton, inflation would likely fall a lot. They'd accomplish their objective and probably start lowering rates again. But that's a fringe scenario at this point. More likely, inflation will come down in 2023, but probably not get to their goal until 2024 or 2025, meaning rates will likely stay in the 3% plus range for the next few years at least. That's not a horrible scenario for the stock market. We get a nice recovery probably starting in 2023, but the valuations of the high growth companies that we've been accustomed to over the last decade would not come back to where they were. Interest rates would be much higher, so all else equal, valuations would be lower. It would also be harder for some of the less established, unprofitable companies to grow as fast as they did before. If a company isn't making a profit, they have to borrow to fund their growth. With higher interest rates, there's just a higher bar for banks to lend to them, and they can't afford to borrow as much. There's less easy money out there to fund their growth, meaning smaller, earlier stage companies might also have a tougher time achieving the higher growth rates we've been accustomed to. This is the new normal I think we are entering into, at least for the next few years, and for as long as we have higher interest rates. If you think the Fed is going to lower rates back to zero, that's when you want to go back into the high growth companies. I don't think it's going to happen for a while, and in this environment, different kinds of companies tend to thrive. Generally, it's better to own companies with pricing power that can pass on inflation to their customers. More near-term cash flows, more reliable earnings, and more dividends. This last part is super important. There are three components of total return: earnings growth, valuation, and dividends. I've spent a lot of time today talking about the first two. How much is the company earning, and how much are investors willing to pay for it? We've already established that companies might have a harder time growing their earnings as quickly as before, and investors won't be willing to pay as much for a given amount of earnings, so dividends are likely to be a much more important component of total return than they have been for the last decade. This is more consistent with most of history, by the way. From 1930 to 2021, dividends made up an average of 40% of the S&P 500's total return. But in the more recent period from 2010 to 2021, it was only 15%. Quantitative easing and ultra-low interest rates distorted the markets, but historically, in higher inflationary environments and higher interest rate environments, dividends have been more important. So allow me to reintroduce you to the wonders of the dividend. A dividend is a return of capital to shareholders. When a company makes money, they have two options. They can either keep it to reinvest in their business, or they can pay it out to the shareholders in the form of a dividend. Some companies with highly stable cash flows and limited growth opportunities, like regulated utilities, pay out almost all of their earnings as dividends. Other companies that have lots of great growth opportunities reinvest every penny they make back into their business and don't pay a dividend at all. And then there's everything in between. In general, non-US companies also tend to pay more dividends than US companies, by the way, for a variety of reasons that you probably don't care about. But if you do, leave a comment and I'll explain. Companies that pay consistent dividends, and especially companies that consistently grow their dividends, tend to be more stable than companies that don't. which is an added benefit in an environment ripe with uncertainty like this one. The reason this happens is that a dividend generally has to come out of earnings. So if a company pays a dividend, it's a sign that their management is confident in their ability to keep making a profit in the future. Growing dividends are even better because investors hate dividend cuts. The dividend is seen as a commitment and a sign of confidence from management. So if they cut their dividend, it's a bad sign, and the stock price usually sells off a lot. Company management doesn't like that, so if they're going to commit to not only pay a dividend, but also grow their dividend, that's a huge sign of their confidence in the company's future stability and earnings potential. Actions speak louder than words. Companies that grow their dividends not only tend to hold up better than the overall market in downturns, but they also tend to do better than the market over the long term. They've been out of favor for about 10 years as low interest rates, low inflation, easy money, and tech innovation have led to supercharged returns and growth opportunities for companies that mostly didn't pay dividends. But that's all changing, at least for the foreseeable future. The age of the dividend is back, and there are lots of good options out there to invest in dividend-paying companies. Just look for a stock fund that has something like income or dividend growth in the name. And of course, you can always look at the yield on the Morningstar page here. One of my favorite ways to invest in growing dividend-paying companies is through American Fund's Capital Income Builder. It was originally formed in 1987 as a solution for a foundation that needed its investments to provide a growing income stream while also growing the principal. And that's exactly what it tries to do today. It aims to grow your money over time while also providing a high and growing income stream through investing in a combination of high dividend paying companies and dividend growing companies. There's also a small portion, around 20 to 25%, of bonds to provide extra stability and extra income. And bonds are another area that's gotten a lot more attractive over the past year. This is not your high flyer, and it's probably never gonna be up 50% in a year, but those kinds of returns are gonna be a lot harder to come by anywhere in this environment. As you know, I don't give advice on this channel and I don't know your situation, but in the investment environment that we're in right now, which I'm pretty confident we will be in for the foreseeable future, until the Fed starts meaningfully lowering rates, I think a lot of investors should strongly consider shifting to more dividend payers and less high growth. Things have changed, and at least in the near term, there's very little chance of them changing back. For a different environment, different kinds of investments thrive, and growing dividend-focused funds like Capital Income Builder could be really well positioned for the coming environment. Well, thank you so much for watching. If you want to know the 9 habits you need to be a successful investor, check out the link below in the description. And if you have any questions about this video, please leave me a comment and I will respond to you. I respond to all comments. Thank you for watching, and I will see you in the next video.